Hey everyone. Okay, so have you ever just stared at your bank account and felt that nagging frustration? Knowing your hard-earned cash is just sitting there, literally being eaten away by inflation? Well, if that's you, you are in exactly the right place. Today, we're going to transform all that financial anxiety into real, concrete action. Think of this explainer as your no-nonsense, totally jargon-free roadmap to start building wealth safely. We're going to take all the intimidating complexity out of the market and just give you the exact tools you need to take control of your financial future. All right, let's dive right into this. We've got 5 distinct steps today to completely demystify investing for you. First, understanding the main asset classes. Number 2, balancing risk and return. Third, the power of diversification. Fourth, actually choosing your investment app. And finally, number 5, mapping out your personal investment journey.
So kicking things off with Section 1, understanding main asset classes. Let's meet the instruments.
I want you to think of these asset classes like a giant financial toolkit, right? You wouldn't use a hammer for a screw. So let's pull out our very first tool, stocks. Now, when you buy stocks, you aren't just trading numbers on a screen. No way. You are actually purchasing a share of ownership in a real, living, breathing company. And historically speaking, the stock market has yielded around a 10% average annual return. It's a direct way to own a slice of global success and, let your money grow right alongside it.
But how does that success actually translate into your pocket? Well, stocks generate profit in 2 main ways. First up, capital gains, basically selling your shares at a higher price than you bought them. And second, through dividends. These are regular cash payouts straight from the company's profits right into your account. But, and this is a big but, you've got to watch out for market volatility. This tool definitely carries higher risk, but it does offer absolutely incredible long-term potential. Now, if picking individual stocks feels kind of like trying to find a needle in a haystack, unit trusts are absolutely your answer. Because instead of looking for the needle, you just buy the whole haystack. Seriously, these are professionally managed portfolios that pool money from thousands of everyday investors to buy a widely diversified basket of assets. You've got a professional manager making all the complex day-to-day decisions for you, which gives beginners a much lower barrier to entry.
And rounding out our basic toolkit, we have fixed deposits, or FDs. You can think of this as your ultimate defensive tool. When you put your cash into a fixed deposit, you're parking it for a set period of time at a fixed, completely guaranteed interest rate. You aren't gambling on market performance here at all. Your principal investment is 100% safe.
So the really crucial point here is knowing exactly when to use this defensive tool. Because your risk is practically zero, the returns on fixed deposits are, understandably, generally lower than what you'd see in the wild world of the stock market. But they provide that essential, low-risk stability you absolutely need for short-term targets. Stuff like saving for a wedding next year or just safely holding your emergency fund.
Moving on to Section 2, balancing risk and return. These are the rules of the game.
Okay, now that we know our instruments, it's time to look at the strategic side of investing to see how you actually survive and thrive. Let's walk through this asset comparison matrix together. Notice the stark contrast we've got here. Stocks give you high liquidity, sure, but they are self-managed and carry a ton of risk. On the exact opposite end, fixed deposits are bank-managed with a fixed tenure, meaning your money is locked away, but your risk is incredibly low. And unit trusts? Well, they sit comfortably right there in the moderate middle. Which brings us to the golden rule of investing. Seriously, take a close look at these bars. To achieve higher potential returns, you absolutely must be willing to accept higher risk. It is quite literally a fundamental law of finance. There's no magic asset out there that offers sky-high returns with zero risk. Your job? Find exactly where on this spectrum you feel most comfortable. All right, Section 3, the power of diversification, strategic management. So moving beyond just picking a single asset means you're building a truly resilient portfolio. And the ultimate defensive strategy for that? Asset allocation. It sounds fancy, but this simply means mixing different asset classes, like stocks, bonds, and cash, to balance your risk and reward according to whatever your goals are. In plain English, it just means making sure you aren't putting all your financial eggs in one basket. If one part of your portfolio takes a hit, the other parts keep you afloat.
Let's see how this actually plays out in the real world. You don't just diversify by asset type. You absolutely must spread your investments geographically. Think about it. If one country's economy slows down, your investments in another country might be absolutely booming. Plus, you want sector variety. Spreading your funds across different sectors, like tech, healthcare, and energy, ensures you completely avoid single industry risk.
Next up, Section 4,
Choosing your investment app. Let's look at some youth-friendly platforms.
All right, let's pick up the pace here because it's time to take action. Honestly, all the strategy in the world doesn't matter even a little bit if you don't execute. So, first up, for the hands-on investor, we've got platforms like Robinhood and Webull. These apps offer incredibly intuitive, totally commission-free mobile interfaces. They are absolutely perfect for those of you who want to actively manage your portfolio, do your own deep dive research, and pick individual stocks.
But hey, maybe you prefer more of a set-it-and-forget-it approach. If so, definitely look at apps like Acorns or Rise. These guys utilize what's called roundup investing. So every single time you buy that ridiculously overpriced artisanal coffee, the app rounds up your spare change to the nearest dollar and automatically invests it into diversified portfolios. It's a completely passive approach that just silently builds wealth in the background of your daily life.
And for those of you who want professional-level asset allocation, but without those hefty management fees, we have robo-advisors. Apps like Stashaway and Siphi. These use highly sophisticated algorithms to automatically build, manage, and rebalance your portfolios based precisely on your personal risk appetite and your time horizon. Basically, it's super smart, automated investing driven entirely by data.
And finally, Section 5, your personal investment journey. 5 steps to launch.
I really want to reassure you here. Going from just holding idle cash to managing a growing portfolio, it's incredibly simple if you just follow a clear roadmap. First, set goals. Define exactly what you are saving for. Second, research your assets and market trends. Third, pick your app. Fourth, actually invest. Start small, for sure, but set up recurring contributions so it becomes a habit. And fifth, review. Check your progress periodically and rebalance to make sure you stay on track.
Before we wrap up this explainer, I want to leave you with a thought that perfectly captures literally everything we've talked about today. The best time to start investing was yesterday. The second best time is today. The tools are literally right there in your hands, the strategies are clear, and the platforms are waiting for you. So, my question to you is, what is the very first move you're going to make today?